and welcome back to the channel. If you opened your crypto app today and saw your portfolio bleeding red, first off, take a deep breath. You are definitely not alone. As of today, December 18th, 2025, Bitcoin has dropped about 4%, and it's currently testing that critical psychological support level of ADSIC's $1,000. A lot of you are probably asking, why is the market crashing? Is this the end of the bull run? Well, today, I'm going to break down the real logic behind this drop using a simple cause and effect approach, so you can understand exactly what's happening in the market. First, let's talk about the macro cause. The risk-off signal? The main reason for this downturn comes from global monetary policy. Central banks, especially in Japan and the US, have started sending what we call hawkish signals. This basically means they might keep interest rates higher for longer or tighten the money supply going into 2026. So, what's the effect? When central banks signal that money is about to get more expensive, big institutional investors switch into risk-off mode. They start pulling their money out of high-growth, high-risk assets like Bitcoin and move it into safer havens. When that massive wave of liquidity leaves the market, the price naturally loses its upward momentum and starts to slide. The second cause is a classic crypto phenomenon, the liquidation domino effect. A huge number of traders were using high leverage, essentially borrowing money to bet that Bitcoin would stay above $88,000. As soon as the price dipped below that level, it triggered a wave of margin calls. Exchanges automatically sold off these traders' positions to cover their debts. This creates a forced selling chain reaction. One liquidation triggers another, and another, creating a domino effect that rapidly pushed the price all the way down to the $86,000 zone. This is essentially a market purge of over-leveraged traders before the year ends. Finally, let's look at the institutional cause. Weakening ETF. The massive rally we saw earlier this year was largely driven by huge institutional buy-in through the spot Bitcoin ETF. However, the latest data shows that these inflows, meaning new money coming into the market, have significantly slowed down. The effect is simple. Without these big whales aggressively buying the dip at 88,000, there just wasn't enough buying pressure to stop the fall. When there's no one big enough to catch the falling knife, the price continues to slide until it finds a strong psychological floor, which is exactly where we are right now. So, is the market fundamentally broken? No. What we're seeing is a healthy technical correction made worse by year-end uncertainty and those macroeconomic jitters. Right now, the fear and greed index is sliding back into fear. Historically, for long-term investors, these fear zones have often been the best times to accumulate. For day traders, though, it's a volatility danger zone. Here are the key levels to watch. First, $86,000. This is our current battleground. If it holds, we could still see a Santa rally before the year ends. If 86,000 fails, the next hard floor to watch is between $84,500 and $85,000. This is where the heavy volume sits. The most important thing is to stay calm, stick to your plan, and don't make emotional decisions based on a 4% move. Thanks for watching. And if you found this breakdown helpful, make sure to hit that like button and subscribe for more updates. Stay safe out there.